Welcome to our comprehensive guide on understanding financial regulations. In today's interconnected world, financial regulations play a crucial role in maintaining the stability and integrity of the financial system. Whether you are an investor, a business owner, or simply curious about how the financial world operates, knowing the basics of financial regulations is essential. In this video, we will break down what financial regulations are, why they matter, and how they impact individuals and organizations. Let's start by exploring the fundamental purpose behind these rules and how they shape the financial landscape. Financial regulations are a set of laws and rules designed to oversee and govern financial institutions, markets, and transactions. These regulations are put in place by governments and regulatory bodies to ensure transparency, fairness, and stability within the financial system. By setting standards for how financial entities operate, regulations help prevent fraud, protect consumers, and promote confidence in the economy. Understanding these rules is the first step toward making informed financial decisions and recognizing the importance of compliance in the financial sector. Primary purpose of financial regulations is to maintain the integrity of the financial system. These rules are designed to prevent financial crises, protect consumers from unfair practices, and ensure that financial institutions operate in a safe and sound manner. By enforcing standards for transparency and accountability, regulations help build trust between financial institutions and the public. This trust is essential for the smooth functioning of markets and the overall health of the economy. Financial regulations are typically created and enforced by government agencies and regulatory bodies. In most countries, central banks, securities commissions, and financial oversight authorities are responsible for drafting and implementing these rules. These organizations work together to monitor financial activities, set standards, and take action when regulations are violated. Their goal is to create a stable environment where financial institutions can operate safely and efficiently. Some of the most well-known regulatory bodies include the Securities and Exchange Commission (SEC) in the United States, the Financial Conduct Authority (FCA) in the United Kingdom, and the European Securities and Markets Authority (ESMA) in Europe. These organizations oversee different aspects of the financial system, from securities trading to banking operations. Their responsibilities include monitoring compliance, investigating violations, and issuing penalties when necessary. Financial regulations can be divided into several categories, including banking regulations, securities regulations, insurance regulations, and anti-money laundering rules. Each category addresses specific risks and activities within the financial sector. For example, banking regulations focus on the safety and soundness of banks, while securities regulations aim to protect investors and ensure fair trading practices. Banking regulations are designed to ensure that banks operate safely and responsibly. These rules set requirements for capital reserves, lending practices, and risk management. By enforcing these standards, regulators aim to prevent bank failures and protect depositors' funds. Banking regulations also promote competition and prevent monopolistic practices within the industry. Securities regulations govern the issuance, trading, and disclosure of stocks, bonds, and other financial instruments. These rules are designed to protect investors from fraud and ensure that markets operate in a fair and transparent manner. By requiring companies to disclose accurate information, securities regulations help investors make informed decisions and maintain confidence in the financial markets. Insurance regulations are put in place to protect policyholders and ensure the financial stability of insurance companies. These rules set standards for how insurance products are sold, how claims are handled, and how companies manage their financial reserves. By enforcing these regulations, authorities help maintain trust in the insurance industry and protect consumers from unfair practices. Anti-money laundering (AML) regulations are designed to prevent criminals from using the financial system to hide illegal funds. These rules require financial institutions to monitor transactions, report suspicious activities, and verify the identities of their customers. AML regulations play a critical role in combating financial crime and maintaining the integrity of the global financial system. Consumer protection regulations are aimed at safeguarding the interests of individuals who use financial products and services. These rules require financial institutions to provide clear information, treat customers fairly, and resolve complaints efficiently. By enforcing consumer protection standards, regulators help ensure that people can trust the financial system and make informed choices. Compliance refers to the process by which financial institutions ensure they are following all relevant laws and regulations. This involves implementing policies, training staff, and conducting regular audits. Compliance teams play a vital role in identifying risks, preventing violations, and maintaining the reputation of their organizations. Strong compliance programs are essential for avoiding legal penalties and building trust with clients. Financial regulations have a significant impact on businesses of all sizes. Companies must invest in systems and processes to comply with regulations, which can increase operational costs. However, these rules also create a level playing field and help prevent unethical behavior. By adhering to regulations, businesses can build credibility and foster long-term relationships with customers and partners. For investors, financial regulations provide important protections and help ensure that markets operate fairly. Regulations require companies to disclose accurate information, which allows investors to make informed decisions. By reducing the risk of fraud and manipulation, these rules help create a more stable and attractive investment environment. Today's globalized economy, financial regulations often extend beyond national borders. International organizations like the Financial Stability Board (FSB) and the Basel Committee on Banking Supervision work to harmonize regulations across countries. This cooperation helps prevent regulatory arbitrage and ensures that financial institutions operate under consistent standards worldwide. Basel Accords are a set of international banking regulations developed by the Basel Committee. These agreements set standards for capital adequacy, stress testing, and risk management in banks. The goal is to strengthen the resilience of the global banking system and reduce the likelihood of financial crises. The Basel Accords are regularly updated to address emerging risks and challenges. Dodd-Frank Wall Street Reform and Consumer Protection Act was enacted in the United States after the 2008 financial crisis. This law introduced sweeping changes to financial regulation, including stricter oversight of banks, new consumer protection measures, and increased transparency in derivatives markets. The Dodd-Frank Act aims to prevent future crises and protect the interests of consumers and investors. Central banks play a key role in financial regulation by setting monetary policy, supervising banks, and acting as lenders of last resort. They help maintain financial stability by monitoring risks and intervening when necessary. Central banks also work closely with other regulatory bodies to coordinate responses to emerging threats in the financial system. Financial reporting standards, such as the International Financial Reporting Standards, IFRS, and Generally Accepted Accounting Principles, GAAP, set guidelines for how companies report their financial results. These standards promote transparency and comparability, making it easier for investors and regulators to assess the health of businesses. Adhering to these standards is a key aspect of regulatory compliance. Transparency is a cornerstone of effective financial regulation. By requiring companies to disclose accurate and timely information, regulators help ensure that markets operate efficiently and fairly. Transparency reduces the risk of fraud, enables better decision-making, and builds trust among investors, consumers, and other stakeholders. Risk management is a critical component of financial regulation. Financial institutions are required to identify, assess, and manage various risks, including credit risk, market risk, and operational risk. Effective risk management helps prevent losses, protect consumers, and ensure the stability of the financial system. Capital requirements are regulations that determine the minimum amount of capital a bank must hold relative to its assets. These rules are designed to ensure that banks have enough resources to absorb losses and continue operating during periods of financial stress. Capital requirements are a key tool for promoting the safety and soundness of the banking system. Stress testing is a regulatory process that evaluates how financial institutions would perform under adverse economic conditions. By simulating scenarios such as recessions or market crashes, regulators can assess the resilience of banks and other institutions. Stress testing helps identify vulnerabilities and ensures that financial entities are prepared for unexpected shocks. Market conduct rules are regulations that govern the behavior of financial institutions and professionals in the marketplace. These rules prohibit practices such as insider trading, market manipulation, and conflicts of interest. By enforcing ethical standards, market conduct rules help maintain fair and orderly markets. Financial regulations often require institutions and professionals to obtain licenses or register with regulatory authorities. This process ensures that only qualified and trustworthy entities operate in the financial sector. Licensing and registration help regulators monitor activities, enforce standards, and protect consumers from unqualified providers. Reporting and disclosure requirements are essential components of financial regulation. Institutions must regularly submit financial statements, risk reports, and other disclosures to regulators. These requirements promote transparency, enable effective supervision, and help detect potential problems before they escalate. Noncompliance with financial regulations can result in severe penalties, including fines, license revocation, and even criminal charges. Regulators use these penalties to deter misconduct and encourage adherence to the rules. The threat of penalties motivates institutions to invest in compliance and maintain high ethical standards. Many financial regulations include provisions to protect whistleblowers, individuals who report violations or misconduct. These protections encourage employees and others to come forward with information without fear of retaliation. Whistleblower programs are vital for uncovering fraud and maintaining the integrity of the financial system. Advancements in technology have transformed the financial industry, leading to new regulatory challenges. Regulators must adapt to innovations such as digital banking, cryptocurrencies, and fintech platforms. By updating regulations and leveraging technology for supervision, authorities can better protect consumers and ensure the stability of the financial system. Cybersecurity regulations are increasingly important as financial institutions rely on digital systems. These rules require organizations to implement safeguards against cyber threats, protect sensitive data, and report breaches promptly. Strong cybersecurity regulations help prevent data theft, financial loss, and reputational damage. Data privacy regulations such as the General Data Protection Regulation, GDPR, set standards for how financial institutions collect, store, and use personal information. These rules are designed to protect individuals' privacy and give them control over their data. Compliance with data privacy regulations is essential for maintaining customer trust and avoiding legal penalties. Financial innovation, such as the rise of fintech and digital assets, presents both opportunities and challenges for regulators. While innovation can improve efficiency and expand access to financial services, it also introduces new risks. regulators must strike a balance between encouraging innovation and protecting the financial system from emerging threats. ESG regulations require financial institutions to consider environmental, social, and governance factors in their operations and investments. These rules promote sustainable business practices and encourage companies to address issues such as climate change, diversity, and ethical governance. ESG regulations are becoming increasingly important in the global financial landscape. Preventing financial crime is a major focus of financial regulations. Rules targeting money laundering, terrorist financing, and fraud are strictly enforced. Financial institutions must implement robust controls, monitor transactions, and report suspicious activities to authorities. These efforts help protect the financial system from abuse and maintain public confidence. Cross-border financial activities are subject to a complex web of regulations from multiple jurisdictions. International cooperation among regulators is essential to address challenges such as tax evasion, money laundering, and regulatory arbitrage. Harmonizing rules across borders helps create a more stable and efficient global financial system. Auditors play a critical role in financial regulation by independently reviewing the financial statements and operations of institutions. Their work helps ensure accuracy, detect fraud, and verify compliance with regulations. Auditors provide an additional layer of oversight and contribute to the overall integrity of the financial system. Financial education is essential for helping individuals and businesses understand and comply with regulations. Educational programs and resources empower people to make informed decisions, recognize risks, and avoid common pitfalls. By promoting financial literacy, regulators can enhance compliance and protect consumers. Financial regulation faces numerous challenges, including rapidly evolving markets, technological innovation, and global interconnectedness. Regulators must continuously adapt to new risks and ensure that rules remain effective. Balancing the need for oversight with the desire to foster innovation is an ongoing challenge for policymakers. Recent trends in financial regulation include a greater focus on digital assets, increased scrutiny of fintech companies, and the integration of ESG factors into regulatory frameworks. Regulators are also placing more emphasis on cybersecurity and data privacy as digital transformation accelerates. Staying informed about these trends is crucial for financial professionals and organizations. Future of financial regulation will be shaped by ongoing technological advancements, changing market dynamics, and evolving consumer expectations. Regulators will need to remain agile and proactive, updating rules to address new risks and opportunities. Collaboration between regulators, industry participants, and consumers will be key to building a resilient and inclusive financial system. The 2008 financial crisis highlighted the importance of strong financial regulations. Lax oversight and risky practices led to widespread losses and a global recession. In response, regulators introduced stricter rules and oversight mechanisms to prevent similar crises in the future. This case study underscores the need for effective regulation in maintaining financial stability. The Enron scandal is a classic example of regulatory failure and corporate misconduct. Enron's fraudulent accounting practices went undetected for years, resulting in massive losses for investors and employees. The scandal led to the creation of the Sarbanes-Oxley Act, which introduced stricter reporting and auditing requirements for public companies. The collapse of Wirecard, a German payment processor, exposed significant gaps in regulatory oversight. Despite red flags and whistleblower warnings, fraudulent activities went undetected for years. The scandal prompted calls for stronger supervision and reforms in financial regulation, especially in the fintech sector. Sum up, financial regulations are essential for maintaining the stability, transparency, and integrity of the financial system. They protect consumers, prevent financial crime, and promote fair markets. Understanding the basics of financial regulations empowers individuals and organizations to navigate the financial landscape with confidence and responsibility. As the financial world continues to evolve, staying informed about regulatory changes and emerging risks is more important than ever. By understanding financial regulations and their impact, you can make better decisions, protect your interests, and contribute to a more stable and trustworthy financial system. Thank you for joining us on this journey through the world of financial regulations.